So here's the interesting thing, guys at Octagon. Don't know if you've been following avidly the markets this week, because it's been a bit of an up and down week. So the markets are very weak, as you probably have seen. The rand has been fairly stable around about that late 16 mark, 1670, 1680. But the strongest barometer, or the most sensitive barometer to sovereign strength, our bonds, are incredibly strong this week. And I find that very interesting. Hey, Steve, Neil, what do you guys say?
Agreed. Sort of looks through a lot of the short-term noise when you see that. You're inclined to look a little bit, what are we missing in the short-term goings on?
Well, I mean, one could interpret it, and I'm not saying that I'm necessarily am interpreting this way, because I actually don't know enough, but one could interpret it. I mean, Neil, you weren't on that Fairtree talk, were you?
Neil was. I wasn't.
Oh, you will. So the lady from Fairtree, whose name escapes me right now, she was, I don't want to say she was positive, because that's not fair, because to say she was positive means she was only seeing the one side. She was extremely balanced. And I think one of the better things she did was she looked through the noise, and she very clearly differentiated between News 24 putting out an article written by a journalist who are largely sensationalists trying to get clickbait and whatnot, and facts on the ground. And she gave a number of examples where she very, very clearly differentiated between now. So that was very, very good. And then one of the things that she really focused on, and I think this could be the reason for the bond strength in terms of sovereign strength. Mark Crom, I'd love to hear your view on this. And he spoke about, she spoke about watch the bonds this week, because if people if the international world likes what Ramaphosa says in terms of corruption, and this was an hour before he spoke on Tuesday evening, or was it Monday evening, Neil? Monday.
I think it was
Monday.
Tuesday. The report came on Tuesday, I think.
Tuesday. She said, if the market likes what Cyril Ramaphosa has to say, bonds will strengthen substantially. If you take a look at our bonds, I mean, in particular, looking at the 186, it's substantially strong. It was trading at 760. It's now trading at 727, bearing in mind that bonds work inverse. So it's quite a substantial strengthening. Mark, have you heard anything there at Sanlam?
Really, Nahi. I mean, it's just so volatile at the moment. Like, I don't know what's going on. Because, I mean, it's one thing to say all the stuff about corruption. It's another thing. Let's see what he does about it. Let's see if anything actually happens.
Yeah.
I think the lady from Fairtree, I think her name was Chantal.
Yes.
And, you know, she pointed out, which I think a lot of us know, is that bad news sells. But we all get caught up in the hype of bad news and forget that there are things happening behind the scenes. And a lot of it's also not reported on at all for the average man in the street to see. But she did seem to have more insight based on conversations she's had, which wasn't just made up, which was interesting. And there was a lot of positivity. So it really was refreshing to hear that there are things happening behind the scenes, even if we're not all really aware of it at this point.
Would you agree, Mark, Neil, that she wasn't blanketly positive? She wasn't like, oh, everything's great. I don't know what everybody's panicking about. It's all sweet. She wasn't that way at all. I found it to be very realistic. But
yeah, I think she was very realistic. Yeah, so if you look at the way she was talking and the way that they have allocated their funds, they're not all in South African ink. If they were, then she would be singing on the same hymn sheet. But she made it very clear that there's a lot of positivity, but they're realistic as well, and they know where things are in South Africa. So we're on a bit of a knife edge. But it was good to see that there is positivity out there.
I mean, her colleague, Charles, he actually did say that about the knife edge. What's very interesting is, I'm not sure who on the current webinar was on the chat when we had Sumesh Chetty from 91 Asset Management. He's a firm favorite, and the funds that he co-manages with Claude Rousseau, the three of them are firm favorites here at Octagon. And they were speaking. I don't think he said it on the webinar, but he said it to us the week before on a private Octagon chat, and he just said, like, he's really not that confident about South Africa. I think I'm being fairly euphemistic, because I think it was a little bit. I think it was a little bit more direct in there. And
he was clear.
He just couldn't see anything positive. And I got to tell you that and I've been saying this to a lot of my clients. So if any of my clients are now and are hearing this for the second time, I apologize. But I think it's really worth repeating. Like 3 weeks ago, I was quite tough about South Africa. I was just saying, like, we really are in a lot of trouble. I mean, we're not winning the war against corruption. We haven't jailed anybody. We haven't actually gotten anywhere. There's a lot of rhetoric, but no action. And one of the things that Chantal did was she actually put up a slide. Morning, Rochelle. She actually put up a slide that delineated the victories of the NPA and the SIU, the National Prosecuting Authority, and the Special Investigating Unit. And she also went to great pains to explain to us when Shamila Batoy, who is a formidable human being, when she came to the NPA, she came to a place of absolute desolation. There was nothing. There were very few competent people working there. Moreover, as Chantal said, she didn't know who she could trust. So we all heard, and I think this is a really good example. You know, we see an article, News 24, 702, whatever it is, right? We see this article, Shamila Batoy, this great white knight savior, she's going to come and sort out the NPA, what, and we're all expecting imminent arrests, right? And I think when I say we, I obviously include myself in that. And then, of course, nothing happens. And it's very, very frustrating because you're not seeing any arrests. You're not even hearing of arrests. You're not even hearing of prosecutions. You're hearing nothing. And you get very frustrated. But what we've got to remember is that she didn't walk into a functional unit, become the CEO of a functional unit, and then continue from there. She actually had to, from scratch, rebuild her unit into a functional unit against a huge amount of headwind, bearing in mind that any success she has puts someone who's currently in authority in jail. So it's really... it's a slower process than we would ideally like, but I took a lot of encouragement from her. At this stage, I just want to take a 2-second. Reggie's about to join us. I'm just seeing his name's clearing up over here. But as soon as Reggie joins us, he is from Sanlam Private Wealth, and he'll also be one of our speakers. Reg, you want to take yourself off mute over there? Say good morning.
Yeah, morning. How are you?
How are you? How are you doing?
All right, thanks. Yeah, I just have to apologize in advance. We're on load shedding here, so the lights are probably going to change in the next half an hour in the background. So,
welcome to South Africa.
Indeed.
Yeah, a story we all know too well. No apologies are needed.
I've actually received a number of email apologies this morning from people who were really looking forward to this and unfortunately won't be able to see it because they have load shedding. But, you know, we were talking, I think Steve mentioned it early on, that we heard from... I've been saying, you know, we were invited to a very private, intimate talk with the CEO of Eskom, just ourselves and about 6,000 other people. Very intimate, and he was brilliant, absolutely brilliant. He was very hard hitting. He took a lot of stuff on the chin, and although obviously he was not the cause of it, you know, he's hopefully going to be the person who over time sorts it out. But one of the things he made very clear, the interviewer, who is Nikki Weimar, that's the chief economist for their group, and Nikki's as hard hitting as they get. She's unbelievably brilliant as a human being, but she's also extraordinarily hard-hitting, direct. She gives you no quarter. And as she was talking, she was saying, so when do you think load shedding will come to an end? And instead of making it up some, you know, don't worry about it, we're dealing with kind of story, he said to me, I can tell you now, it will not end before September, October 2021. Okay, so we are stuck with it. Yeah, in fact, he even said, those of you who are considering buying generators, there's your answer. You've got another year at least. He also, though, which was so encouraging, I mean, we're not going to really get a chance to talk about prescribed assets today, sorry. But I'd like to, we've got a few more minutes, about 5 or 6 minutes before we actually start. And I'm actually going to just lead in with that. And Octagon team and Mark and Reg, please be part of this conversation. But a lot of us are really fearful about this pending legislation of prescribed assets. The initial fear would be that the government would take our pension money and force us to invest these into one of two options, either state-owned enterprises, the likes of Eskom, PRASA, SABC, who this morning asked for 4.9 billion rands in bailout, by the way. That was in this morning's news. So, it came in last night, was discussed again this morning. So we were going to be forced to invest into these, or worse, there was rumors about a state-owned bank, which to me is state-sanctioned looting. So this would have really been a disaster. But over the last 2 weeks, 91 Asset Management, our corporate partners, Sanlam, Ned Group, Alan Gray, Coronation, and Fairtree have all come out with categorical statements saying that if you actually follow what the government have said, and again, Neil will correct me, telling me that Chantal didn't say that there was always the government's opinion. I think she was of the opinion, this is from Fairtree, Fairtree Asset Management, that government have actually heard that they don't have the leeway they thought they were going to be able to impose, and they are kind of walking back some of their original ideas. And they were talking about, excuse me, potentially only going into what they call government infrastructure projects. And it was going to be on a voluntary basis. And I started thinking to myself, well, what is a government infrastructure project? Is that not a state-owned enterprise? What's the difference between a government infrastructure project and a state-owned enterprise? You can call it by a different name, but ultimately it's the same kind of thing. And actually, no, it's something substantially different. And my understanding is that in fact, the CEO of Eskom made it very clear that one of the reasons that they are splitting up one of the reasons they're splitting up Eskom is because 2 out of 3 of the divisions, these new divisions that will ultimately, how Eskom will ultimately be broken down into, are extremely profitable. And they want us to be able to invest into these. And if you listen to what 91 Asset Management is saying, if you listen to what David Chief Strategist for Sanlam, David Galloway, thank you. David Galloway has been saying he's also really, really positive about this, and he sees this as a wonderful option for us to invest in government infrastructure projects at preferred rates. So this could really be something quite exciting for us. That's what. So, ladies and gentlemen, it's now 10 o'clock. What we typically do is we start at about 10:05. There are a lot of new names this morning, so I'm assuming that most of you haven't been on one of these before. But I'd just like to tell you how we work. So we start at about 10:05. I'm going to give a quick economic update and then specifically talk about our very exciting topic of this morning, offshore investing. And we have 2 brilliant speakers. We have Mark Crom from GLACIER, which is by Sanlam, and then we have Reggie Labuschagne, or Labuschagne if you bet for Australia. Then your surname would then have been changed to some other bastardization, but we'll call you Labuschagne as we live in South Africa. And Reg is from Sanlam Private Wealth, and he'll also be talking just about offshore. So we're going to be talking in a minute. I'm just watching the numbers ramping up quite quickly over here, so I know that we have people joining. But I just want to finish off this prescribed asset conversation. Being 47, and having substantial of my own assets sitting in retirement annuities, this is something that caused me a great deal of angst because I don't have options. I'm not one of those people over 55 who can convert into a living annuity. I don't have space to go. I mean, Rochelle would be in the same space. Neil's 21, he'd have the same problem. Steve would have the same problem. So we really would be in problems. But as things stand right now, it's actually quite exciting because it looks like what was going to be quite a disaster from a prescribed asset standpoint can actually be something where we could actually contribute. And I know this sounds naive, but bear with me for a moment. I think we can genuinely be positive contributors to the better future of our country, and actually be able to do so in a constructive manner instead of throwing money down the drain, which is fairly typical when it comes to what happens with government. So I'm actually quite excited about it, to be honest.
I think, Menachem, if I can just have maybe one comment to that. So I think, look, it will be very difficult to just come with a blanket statement of here's prescribed assets and, as you said, throw it into SOE. I think as much as we don't have that much faith in what some of the policies are, and I think the track record's been poor. I think if that happens, your saving rates in this country will plummet. I mean, I certainly know for myself, and speak to a lot of my colleagues and just friends. When the first notion of that came up, people say, "I'll just stop contributing to a pension. I'll pay my taxes and I'll take the cash out the country." So that won't be positive for anyone. So I like the way you framed it, and I think that's important to say that we can go into quality assets at the end of the day. If that's the possibility and it's on a voluntary basis, we can certainly contribute. And I think we all need to contribute in some way to this country.
We need to be part of the solution.
The talk today is offshore assets, and I think we're helping a lot of clients financially immigrate, which we know is not the it's the right thing for the clients, but it's not good for the country long term. So we need to be at some stage. You hope that as asset allocators and capital allocators, hopefully we can start adding to good projects in the country that all have the economic spin-off in the long term, which we all want. I mean, that's the reality.
I'm fully in agreement. I mean, sorry, Stephen, what is the CEO of Eskom's name? I've gone blank.
Andre de Ruyter.
Andre de Ruyter, thank you. So when he was first hired, and Reg, this goes back to exactly to your point. He was interviewed, and the journalists were just astounded that I was saying to him, "Why would you take this job on? I mean, why would you do that to yourself?" And his answer was actually really brilliant. He said he kept on going to Saturday afternoon brass and hearing what a disaster our country is. That's all he heard. And he thought, well, I've got one of two choices. I can either become one of the naysayers, which, by the way, I'm not blaming anybody as a naysayer because I think we're in a tough neighborhood. But he says I can become one of those and just sit over there and have a drink or two and talk about how bad our country is, that our taxes are being wasted, that there's nothing we can do and that we should get out of this country, etc. Or he says, I could become part of the solution. And he says, and I'm not a kind of guy who sits in the sideline. I'm a solution-driven person. I'm going to find a solution. And I think it's amazing. And if you just see, I mean, his talk was formidable. And I look at him and you talk about how he spoke in great detail, Reg, about how they've broken down Eskom, that they've got things working. I know it's an ironic statement today. We're all under stage 4, and so many of the people who wanted to join us today won't be joining us today because they can't get on because of load shedding. But notwithstanding that, we're actually really, really excited about certain parts of South Africa. We think things can come right. So I'm actually going to start, ladies and gentlemen. We try and start as close to 5 minutes. I firstly want to welcome everybody this morning and thank you all very, very sincerely for joining us. I'm going to ask you to please take a moment just to mute yourself, and mute you'll find at the bottom left-hand corner of your screen. And the format for today is I'm going to talk for about 15 minutes, just a bit about Octagon and a bit about offshore investing in general. And then, as I mentioned before, we have Mark Crom from GLACIER by Sanlam, which is the platform that we do a lot of our offshore business with. And Mark will take you through that. And then you've just heard Reggie and I talking, Reggie from Labuschagne from Sanlam Private Wealth. One of the really cool things is that Reggie's boss, Carl Whitman, is the CEO of SPW, Sanlam Private Wealth, and happens to be our chairman. So we're actually more than family. We're like really, really close family. But before
may I just make a suggestion, please? Because of load shedding, maybe people can switch off their videos as well.
Okay. And then I also want to just begin and make very, very special welcome to Philip Brody. Philip lives in Israel, and we have a joint venture alliance with Philip. Philip runs his own financial services company in Israel, highly successful, and he is one of our strategic alliances in Israel and particularly in Europe. So we want to welcome you this morning, Philip, and it's very, very, very good to have you over. Good morning. Thank you for joining us. So today is before I forget, 2 bits of housekeeping. Firstly, this is a recorded session. So if anybody is unable to join, if I could also ask Susan, there are people who are telling me that they're trying to get on and they're sitting in a waiting room. So Susan, if you could please watch that and let them through. Thank you very much. And then, as I said, 2 bits of housekeeping. Number one, there's always recorded sessions. You can find them on our website, octagonfinancial.co.za, under the news section. So please feel free to go there. And if anybody is unable to join us, that's where you'll find this information. Secondly, there's a chat section. At the bottom, you'll see their chat, and you're welcome to send questions throughout. And when we're over, we'll deal with all the questions. But please feel free to ask questions. You can either direct them directly at your advisor, or at everybody, or at me specifically. And during the talks, we'll collate these questions and ask them at the end. So without any further ado, I just want to jump into it. I am going to put together the presentation here. Not all that good at technology, but if you just bear with me a moment. As I get myself started. There you go. I think everybody should now see us over there. Thank you. Okay. So I think when it comes to offshore investing, there's a lot of myths, and a lot of people are very intimidated by offshore investing. And the reason they're intimidated is a number of reasons. Number one, I think very few people actually understand offshore investing. Number two, I think it has a certain reputation. It's either for the super wealthy or for people with a very, very tolerant risk profile, or that's the one. And then a lot of people in the early part of my career, so I started in financial services in 2000, 2001, and that during that time, offshore investing was really not a profitable operation. Many people, I've just been asked, ladies and gentlemen, I have to say this aloud. I've just been asked to slow down a bit. In my enthusiasm, I get carried away and I speak very, very quickly. So yes, Uncle Aaron, thank you for that reminder. I will speak substantially slower. Well, I'll definitely try. Thank you. So a lot of people had really bad offshore experiences. But then one of the things about investing that we've got to remember is that investing is cyclical. There are certain segments that do well at certain times and others that do well at other times. And we need an experienced advisor to help us navigate our way through this. Here's a beautiful quote. In fact, sorry, before I forget, I want to just to thank Stephen and Susan for putting this PowerPoint presentation together. I always say that I'm the one who gets to present, but I have to say that it's not me who prepares these. So thank you to the two of you for helping put this together. So the quote is, how many millionaires do you know who become wealthy by investing in savings account? I rest my case on Robert Allen, a well-known investor. And the truth is that there are times, certainly over the last couple of years in South Africa, where it looks like a bank account is the place to be, because markets are so volatile and you make money and then you lose the money that you made and then you finally get into the markets. And what we know, and we don't have it on the screen, but I'm happy to discuss it, is that long-term investing, staying in the market and not trying to time the market. And of course, this can be extrapolated to not trying to time the rand. I recently was discussing with a client about we were going to do quite a big asset swap, which we're going to be discussing in a moment. And we were trying to time the rand. And ultimately, we decided that you can't. You've got to have an investment case that is almost beyond the rand's volatility. So here are some myths about offshore investing. I want to add a couple to this as well. So as I mentioned before, a lot of people believe, and a lot of experienced investors believe that only the super wealthy can invest offshore, can afford to invest offshore. People have this misnomer that when they invest offshore, they lose control. Now, I know that you're investing through an advisor, but we at Octagon often try to take you through the process of investing, that you are part of the process. And people have this misnomer that when you invest overseas, you're kind of throwing your money in, who knows what's going to happen to it. And we're going to show you that that isn't the case. The second thing we say is, with the rand volatility, how safe is our money overseas? Or are we actually going to be able to know where we are? And then risk. Now, without doubt, the most important investment tool when investing locally, offshore, anywhere, is understanding your own risk profile. I'm going to take a moment or two to discuss this. What is a risk profile? A risk profile is your being comfortable with taking risk. I have this little quip I say to my clients. How much money are you prepared to lose in the short term to make money in the long term? That's a very unsexy way of talking about investment. Surely we should be talking about great returns and how much money we can make for you. But of course, the responsible side to investing is understanding how much money you could tolerate losing. My father is 81, maybe. Well, if I said to him, Dad, how much money could you lose in the short term? I would hope that he would say to me, not a penny. I'm 81. I don't have time to make back this money. But if you say to me, at roughly half that age, if you said to me, how much money could you use? I'm saying I'm not retiring right now, so I have time. And I think understanding your risk is incredibly important. Another misnomer is that investing overseas is substantially more complicated and substantially more expensive than investing in South Africa. And I'm very happy to tell you, and I know Mark Crom's going to take you through this in a moment, that it's no more expensive than South Africa, and it's no more complicated. And we have worked very hard. We're going to take you through our suite of products to show you that that isn't true. And then, of course, the big one is, how legal is it to invest overseas? Does the government allow us to invest overseas? So let's take a look at what our allowances are. There are two legal allowances. Each person, each taxpayer, has a 1 million rand annual allowance for discretionary investing. Now, that includes, by the way, any travel, if you're assisting someone overseas and paying their rent or whatever the story might be, that's all part of that 1 million rand. But if you're not doing that, you have an annual allowance of 1 million rand, which you can actually do on your bank. Go onto your bank now. I bank with First National, and there's a tab, Forex, and I can go and pay or invest money on that, up to 1 million rand per annum. And in addition to that, you have a further 10 million rand per annum. Steve has written here through a 12-month investment cycle, but it's 12 months, another 10 million rand per taxpayer that you can invest. And so for the vast majority of even comfortable South Africans, this takes care of their wealth. I mean, and a couple, that's 22 million rand per year. But what about a couple who've got more than that? What about a bloke who's got 100 million rand? Guy runs a business, sells his business, gets 100 million rand, substantial amount of money, and now wants to invest all that money overseas because he's worried. Well, we're going to get to that in a second. So the first thing is, what are your options for investing money overseas? So as Stephen has said over here, he's spoken about Rand hedge shares. You see, you probably know that the Johannesburg stock market is one of the most, if not the most, diversified stock market on earth. And the reason for that is more than 60% of South African stocks are actually offshore denominated. Mining companies, we've got over here Naspers, British American, Tobacco, Richemont. These are companies trading on the Johannesburg stock market, but derive the vast majority of their income from foreign denominated income. So that's a very interesting way of protecting yourself against the challenges in South Africa. The next one, I'm going to just swap these two around. I'm going to speak about the one on the far right. That's you're using those allowances that I spoke about on the page before. But the middle one is something that's very exciting. One of the limitations and the inhibitions of being able to invest overseas is in a company. So let's take Octagon Financial Services. Thankfully, we're a cash generative business. So if I wanted to invest money of Octagon Financial Services overseas, would be very difficult. I'd either have to declare that money out of Octagon Financial Services, all the various shareholders would get their money, and then I would be able to invest my money, or via what's called asset swap. And an asset swap essentially is exposing your money to overseas, but you actually are not physically taking it overseas. So you don't have to apply for an allowance to do so, but you can go into the same funds that you otherwise would. And I know that Mark will talk about that in a second as well. And once the money is overseas, where does that money sit? Okay, so you've now taken over your allowance, you've used your 1 million rand allowance, you've used your 10 million rand allowance, you use in conjunction between your 10 million rand allowance and an asset swap allowance or whatever it is. And now the money sits overseas. What are your options? So we try to tell clients, we have built our offshore portfolios to be as user-friendly as our local portfolios. So let's discuss a local portfolio. You're going to just look at your own portfolio for a second. You can have exposure to cash. You're going to have the various asset classes. You're going to have bonds, property, equities. You're going to have some currency play in there. You might have a direct share portfolio. Rach will talk about that in a moment. You're going to have the whole suite of products within your South African portfolio. Well, we'll do the exact same thing for you overseas at no greater cost than in South Africa, with the same kind of flexibility. And that's what we're going to talk about. So before we finish, one of the things that I like to focus about investments, now whether it's local or offshore, is there are two segments to an investment. There's the platform that we use to enter into the investment, and then there's the underlying investment itself. And each one of these have a very fundamental role to play in investing, because there are challenges to investing which are obviated largely by your platform that you use. Let me give you an example. A person invests overseas, as Stephen put in his presentation over here. One of the challenges is tax. So a person takes 10 million rand, they invest that overseas, or 1 million rand overseas, or 100,000 rand overseas. Remember, the quantum of money doesn't change the story. It's still the same challenges. So a person takes money overseas and now has $50,000 overseas. And that 50,000 grows to 55,000 good year, we make 10%. That 5,000 rand tax at some stage has to be paid in South Africa. And Mark will describe to you what I mean by at some stage, but at some stage you have to pay your tax, okay? Now, you've got two options in paying that tax. Option number one is you denude your local cash flow to support your offshore tax liability. And the other option, sin of all sins, you bring money back from overseas to support your tax liability, which is innate, because the whole point of taking money overseas is not to bring it back or until you absolutely need it, and certainly not to support a tax liability. So one of the things that Octagon does is we use a product like Mark Crom's product from GLACIER by Sanlam, which wraps your investment and it pays tax on your behalf so that you don't have to use your cash flow to do so. The other thing it takes care of is beneficiaries. So you can have a product that is duly owned. It's a wonderful idea. My wife's name is Adrian. Adrian and I have an offshore GLACIER product, which is co-owned. So if I pass away, she co-owns it. And if she passes away, God forbid, I co-own it. Our children are the nominated beneficiaries of this. So if we both pass on, our children get their money. Instead of, I had a nightmare case. I'm almost done on my side, but I had a nightmare case a couple of years ago where a client had money in a very well-respected offshore bank, connected to South Africa, very, very well-respected bank. In fact, they happen to be my offshore bankers. He never had a will. And it landed up happening. It's an extreme case, but it did happen. He was an elderly gentleman. His daughters are in their, I think, late 50s, early 60s. And the person who wrapped up the estate eventually had no option but to bring them, both daughters live overseas, to bring that money back into South Africa so they could distribute it to the daughters, both of whom living overseas. So he had a cross-currency risk, he had a taxation risk. All of this is obviated by a good wrapper such as GLACIER International. It takes care of the tax, takes care of the probate issues. So one of the things that we really want to bring across is that offshore investing can be made really simple, user-friendly, and available. We are unbelievably excited because GLACIER have literally just launched, Mark, you correct me, I think it's 2 days ago, have just launched this new platform which inter alia drops the minimum to that 100,000 Rand that we've spoken about. There's a whole new vogue of investing overseas, which allows a client to have a balanced portfolio with both local and offshore portfolios, all reporting in a simple way. That's the one side. Now, where do we put your money when we go overseas? So Octagon runs $3 funds offshore, conservative, balance, and growth, and we run £3 funds, conservative, balance, and growth. And with our corporate partners, Sanlam, through Sanlam Private Wealth, as Lewis Cockney will talk about in a moment, we also have a stockbroking division available offshore, as well as a trust division. So really going overseas and investing overseas, which today is pretty much a must in a well-diversified portfolio, has been made a lot easier over the last few years. I'm going to finish with a quote and saying, markets constantly change, but good investment advice is timeless. And I can tell you, I've been doing this for nearly 20 years. And how often I will meet a client whom I met 18 years ago, and they will quote the advice that I gave them 18 years ago, having followed it diligently. And I'm always very gratified when I hear that. And I always go, who gave you that advice? That was damn good advice. It always turns out, thankfully, to be me. And at the end of the day, advice that is well thought out will last the test of time, even in volatile markets. So, you know, at Octagon, we speak about leading the way to financial freedom. And what do we mean by this? At the end of the day, all of us are busy being attorneys, running factories, trying to, you know, be retired folk and worrying about spending time with grandchildren, not having to worry about finances. That's Octagon's job. Our job is to worry about your finances and make sure that you are able to retire in style. And what we do in order to do that is we make use of what we believe is the very, very best that the broader market has to offer. And so I'm going to now hand over to Mark Crom. I'm going to just close down mine. And Mark, if you bear with me a moment, I'm going to put you onto Spotlight. Mark, you should be there. Are you there? You want to put your camera on?
Lucky, thank you. Yeah, let me just get this presentation.
Let me know when you're ready.
Yeah, I'm just trying to share screen here.
There you are. You're up.
There we go.
Fantastic. Thank you.
Okay. Firstly, I want to just thank Menachem and Octagon for giving me the opportunity to chat today. We've been obviously working quite closely with Octagon for a number of years on, both on the offshore and the local side. So, Naki, thank you again. You've pretty much done my whole presentation for me in terms of touching on all the valuable points. But going right into it, I think it's essential when taking money offshore that you invest in the correct structures. It works slightly differently to a local perspective, because you've got to remember, when you're taking money offshore, you're investing in a number of geographical jurisdictions. And each jurisdiction will have its own implications when it comes to tax, when it comes to financial planning, when it comes to estate planning. And looking at and if you're not structured correctly, it can lead to all sorts of complications down the line, from generating offshore estates to generating to actually physically paying out to beneficiaries from a tax perspective, etc., etc. And that's where we've got a product that that meets all those criteria. So we offer two structures. The first structure that we're going to talk about is generally for your high net worth clients, which is our wrapper structure. And then, as Naki said, we've actually just launched a brand new product called the Offshore Investment Plan, which makes entry into the market a lot cheaper. Because technically, what people have been doing on the local side is to gain access to offshore funds and offshore exposure. They've been using the likes of asset swaps and feeder funds, and it creates a tax implication. And the new product is a way around this tax implication. So we're going to start off by talking about our global life plan and our global investment plan, which is technically the same structure, but just one is for an individual and the one is for an entity. But essentially, a wrapper structure is the structure that is going to protect you from a tax point of view, from a financial point of view, and from a estate planning point of view when taking money offshore. So essentially, this wrapper is almost like a trust, and it provides certain benefits. And then within that product, you would then turn to the Octagons and to the SPWs for internal planning in terms of where you actually place your money. Are you going to go conservative? Are you going to go aggressive? Are you going to go into a share portfolio? But essentially, this is the structure that it's all housed in. So if you look at our global life plan, and our global life plan is our wrapper structure through Bermuda, it answers all the questions that you're looking for. So it looks at estate planning, it looks at probate, it looks at tax planning and insolvency protection. So from an estate planning point of view, just as an example, when you take money offshore and you invest in, for example, an American stock, you're liable for American estate duty. Sorry, something just popped up on my screen.
Mark, could you perhaps turn your camera on?
Yeah, sure. A sec.
There you are. Thank you. Thank you.
So as I was saying to you, let me just get this reverse. As I was saying to you, just as an example, when you're investing in the US and you invest, or not even in the US, if you just got a custodian account, no matter where that custodian account is based, so whether it's Swiss-based, UK-based, actually doesn't really make a difference. When you're buying underlying stock that is registered in America, I'm going to use America as an example. You're liable for death duties in America, and death duties in America are 40% on anything over $60,000. So essentially, a tax wrapper protects you from all different estate duties in jurisdictions. So there will be no estate duty, and the reason why there is no estate duty in other jurisdictions is because it's not owned by the individual, it's actually owned by the company. The company in this instance being Sanlam. So essentially, the wrapper never dies. It's not like an individual which dies and then is liable for estate duty. It never dies. There will, however, be estate duty implications in South Africa. So when you die in South Africa, you look at your overall estate, and the asset will form part of your overall estate from an estate duty calculation point of view. But it doesn't attract offshore estate duty. On top of that, when you're creating a global life plan or a wrapper structure, you've got the ability to have multiple owners to the structure and multiple beneficiaries to the structure, which means in the event of death, essentially it will you personally just fall off the plan, and the plan will either continue in the name of the joint owner or alternatively the beneficiary, which means from a winding up point of view, there's no need for an offshore will, There's no need for an offshore executor or a local executor to deal with that portion of the estate. It's a simple process of sending through the death certificate to the administration team in South Africa, which then gets sent off to Bermuda. That person is taken off the plan, and the plan will then continue in the either the beneficiary's name or the joint owner's name. So it makes estate planning very simple and very seamless. SATA's assets, as I mentioned, is the offshore estate, and through a wrapper, there is no creation of an offshore estate. The big one is tax efficiency. So within a wrapper, all tax is done within the wrapper structure. So from an individual client perspective, there's no reporting of any tax through to SARS. It's all reported by the life company, which in this case is Sanlam. So Sanlam pays all taxes on the client's behalf. On top of that, it's paid at a preferential rate. The rate that it's used is what's known as the FAR fund approach, which is the corporate tax rate. So essentially, this can change, but at the moment, CGT is 12%, income is at 30%, and divvies are at 20%. Just to give you an idea, in general terms, CGT in the individual capacity would obviously be 18%, where you're now getting it in the wrap at 12%. So there is quite a differential on that. And on top of that, it doesn't have to be declared. So there's no tax certificates that are received at the end of the year. There's no reporting to SARS at the end of the year. It's a clean investment. Once it's done, all taxation is taken care of. In addition to that, as Malcolm was saying, Octagon run 3 different model portfolios. All those model portfolios are what's called accumulation funds. So what that basically means is there's no distribution of income and dividends. So essentially, there will be no tax until such time as Octagon decides to rebalance the model portfolio. So only when they change the weightings within the portfolio will that trigger CGT, but it or income tax or dividend tax. But it doesn't. But if there was no trading in the portfolio, there'll be no tax generated during the year, which is very different to a South African portfolio. The other key thing about a wrapper, and this is a very big advantage compared to a asset swap fund or a feeder fund, is that all taxation is taken care of in US dollar terms, which basically means that if you've got a portfolio which hasn't grown, so you invest $100 and you redeem it at $100, the CGT implication is nil. Whereas certain funds, if you invest in South Africa, like feeder funds or asset swap funds, it takes the rand depreciation into account. So what I mean by that is you could invest in a dollar portfolio at $100. Your dollars at the end of the day could still remain $100, but the exchange rate could move from when you took the money out at 15 to 1 and now it's 20 to 1, and you've made a gain on a currency, and that would create a tax implication. So that's something that you've got to be very, very careful of, and brings me back to my first point in terms of planning and why structures are so important. Because if you did go into what's called a feeder fund, you penalized on the rand depreciation, which we'll talk about shortly. A big benefit of a wrapper structure is once the money's been invested for a 3-year period or longer, it's provided, you get protection, you get creditors protection, which means that should anything happen to you from an insolvency point of view, the asset cannot be touched by any creditors. So it behaves very similar to a trust, except doesn't attract the same fees that a trust would typically attract. From a reporting point of view, everything is done online. Everything is priced daily. So clients get access to online access from a GLACIER International perspective. Within the plan, they'll be able to see the underlying portfolios that they invested in. So if they invested in, for example, a Octagon moderate portfolio, and on top of that, an SPW discretionary portfolio, it will all be online access. The client will have live valuations. You'll be able to see your daily price, your daily movements, your capital gains tax implications. It's full online access and full online capabilities. So just this slide is very important. I mean, it touches on the differences between having an investment within a structure and without a structure. So just looking at a tax implication point of view, should you have not been invested in a structure, you're looking at a CGT rate of 18%. On top of that, all calculations would have to be done by you, the client, all reporting would have to be done by you, the client, to SARS. And on top of that, if you were invested in offshore assets, which you're obviously going to be in certain jurisdictions, you would be subject to offshore state duty and inheritance tax. Going through the wrapper, it brings that CGT rate down to 12%. It takes away your reporting benefits to SARS, because that is all done by GLACIER International or by Sanlam. And from an estate duty point of view, there's no creation of an offshore estate. So there would be obviously a state duty in South Africa at the normal South African tax rates, but there would be no creation of an offshore estate. Going alone without going through a wrapper would cause what's called probate. Probate is basically the winding up of your estate. Essentially, you would need a will, you would need an offshore executor, and all these things cost money and it costs time, and it's very difficult to deal with on death. Whereas through a wrapper, there's no need for an offshore estate, there's no need for an offshore will, because on the global life plan or on the wrapper structure, you've got the ability to have beneficiary nominations and joint ownership nominations. So obviously, just depending on the way that you want to structure it, but if you've got a beneficiary nomination, all that would happen is on death, it would simply pay out to that beneficiary. Then from a flexibility point of view, there's just a lot of investment options within the wrapper. So it opens you up to a lot more than obviously going individually. As Manako mentioned, we just literally got a new product signed off by the FSCA yesterday. And the product is now going to open up offshore investing to pretty much the mass market. So on a global life plan, it's generally your higher net worth client that we're looking at, where because minimums into the product are 25,000 US. Now we're looking at minimums of 100,000 Rand. So it's not a wrapper structure, but what this structure does is it allows clients to invest offshore without having to go through what's called feeder funds. So typically what's happening at the moment is when you go to your Octagon advisor and they're using offshore allocation, they're using what's called feeder funds or asset swap funds. Now, the pitfall of an asset swap fund or a feeder fund, as I touched on earlier, is when you tax, when you ultimately redeem the product, you taxed in Rand terms, which means that it takes your gain in dollars and it takes your gain in Rands. So it uses the differential between what you took the money out of the country at and what you brought the money back into the country at. And that gain is taxed. And with the volatility of the Rand at the moment going from 15 to 18 to 19 pretty much overnight, that's all of a sudden 10, 11, 12, 13% on capital gain, but your actual underlying investment in dollar terms hasn't really done too much. So the new product is going to open up offshore investing to pretty much the mass market. From a minimum point of view, we're looking at minimums of $100,000. Liquidity to the money is within 5 to 10 days. So it's literally a matter of anytime you need to redeem the money, it can be redeemed. The price of entry is a lot cheaper. And in terms of paperwork, as Manako mentioned, access is really easy. There's a misconception in terms of going offshore that it's complicated and it's a lot of paperwork and it's a big schlep. But at the end of the day, it really isn't. It's pretty much the same process as investing locally. And this product is really going to open the doors to mass market clients taking funds offshore. I don't want to really touch too much on this, but this is just basically, if you look at the difference, this is just the portfolio. If you're looking at cost terms of investing direct or investing in a feeder fund, and it uses the same figures, except that it uses depreciation of the Rand. So it's basically saying when you took the money out at 15 and now the dollar is at 17, you can see on the bottom right-hand corner, the difference in CGT would come to around 310,000 Rand. But basically the point that I'm trying to get at you is on a feeder fund, you're taking Rand depreciation into account when looking at a capital gains tax calculation, whereas on a direct fund, you obviously removing that risk completely. And that's why it's so key, whether you're going into the global life plan on higher asset value clients, or if you're going into the global investment plan on lower clients, that you get your structuring correct and you avoid these tax pitfalls. And if you have any questions around that?
Not at this stage, Mark. There actually have been quite a few questions coming through, but what I'm going to ask is we're going to go to Reg, and then at the end we'll ask all the questions together. But Mark, you said that I gave away half your presentation. No, I didn't. That was a brilliant presentation. Thank you very, very much. Okay, if I could just ask, I'm now going to ask Reg if you could sorry, so Mark, if you could close your presentation down, please.
Yeah, I'm doing that now.
Fantastic. Mark, Reg, the spotlight's on you, and you should have rights to share as well.
I'm just waiting for it to open. Give me 1 second. Okay, can you see it there? I'll assume it's come through.
Yes, thank you.
Okay, great. Yeah, I think, Menachem, thanks for that intro, and I think echoing what Mark said earlier, just thanks for the opportunity to speak to yourselves, your colleagues and your clients. I think maybe, Sun and Private Wealth is not always the better known entity around. So I'll maybe just do a brief intro, and then we'll get into, I think, the nuts of the nuts and bolts of what we are trying to cover today in terms of the global stock portfolios. But I think very important, just going, you've heard now from Menachem first. So I think for any, as you know, as clients, the starting point is obviously sitting with your advisor, getting to know you as a client. You've now heard from the platform. So Mark has given, I think, quite a lot of information, how you'd structure your investment to simplify your life. And it doesn't always sound like that, but where I sit from a product side, if I have to look at the complexities we deal with investing across the world, dealing with something like a GLACIER life plan certainly simplifies all of that for you. As Mark said, taking care of your taxes, taking care of your estates. And I'll touch on that just now when we come to direct share portfolios, because I think it's very important. But maybe just so where we sit in the back is we the people in the back that have to manage your money and make sure that we try and deliver a return over a period of time for you once you've made all the right decisions on your structuring and getting your money into a certain position. So maybe just a bit about Sun and Private Wealth, as I said. So Sun and Private Wealth, we basically, it always sounds interesting, wealth is a very generic term in this market, but we basically deal with private clients. So we're essentially an asset management or an investment management business. Why we call ourselves a private investment management business essentially is we deal with private individuals. We don't manage large pots of institutional assets or large funds. We deal with individuals through Octagon, at the likes of Octagon. We deal with a lot of intermediaries and their clients, and we help them manage portfolios that are suited to an individual. So we don't just put you in a generic pool and necessarily let you look like everyone else. Where there's a need for clients to have specific requirements or certain things left out of their portfolio, included in their portfolio, that's where we can do the customization around the portfolio. But as I said, first and foremost, we're an investment house. So we've got to have a very sound process. We've got to have a very sound philosophy, because without that, we can't deliver a good return for clients over time. So I'll touch on that in a bit. But we've got, just so you know, about offices and representation in about 4 jurisdictions. We're also looking at 1 or 2 new jurisdictions at the moment. Some of our clients, we set up, we've got a trust company in Mauritius as an example. More and more of our high net worth clients that are going, taking money into first world countries are not that comfortable with Mauritius. So we typically would look at something like a Guernsey or a different jurisdiction for them. But ultimately we sit with quite a number of staff across all these jurisdictions. And in total, we manage and administer about 150 billion Rand on behalf of clients. So we've had very good growth in the business over time. And that's obviously thanks to the likes of Octagon and clients that have trusted us over this period of time. We do a range of products and services. We're going to focus mainly on the offshore stuff today. But I think maybe just an important point, Menachem, to mention is on the fiduciary and tax side. And I think it ties in a lot with what has been said by both of you already, by both you and Mark, is our starting point with the client is always understanding through their advisor what their requirements are and getting that structuring right. And it's interesting. One of our top tax specialists, Anton Maskovets, is actually probably one of the biggest proponents of the global life plan because of all the complexity. So he's always one of the guys that says, as soon as you go into direct equities or direct securities offshore, it's always better holding that through something like a global life plan, just because of everything Mark has mentioned already. So I'm not going to echo more on what's been said there. I think he covered that very well. Just in terms of the offshore investment products, we've got a range of products. We're going to focus mainly on this end bit here, on the equity side, which is really fits into that aggressive bucket for people looking for growth into the long term. So we've got 3 different equity portfolios that we manage, are direct equity portfolios. So it doesn't sit in a fund. We've got an equity diversified portfolio, a focused portfolio, and an income portfolio. The diversified is basically just it's about a 25 to 30 stock portfolio that looks to give clients a good diverse exposure to different equity markets across the globe, which I'll touch on in a second. The focus portfolio is literally a very cut down version of that, where we give clients a highly concentrated exposure of about 15 to 20 global stocks. And then the income portfolio is a bit more focused on providing some form of global income to clients, like a dividend income stream off the back of that. I'm also going to touch a bit on the global high quality fund, because the global diversified portfolio and our fund are basically 2 things that mirror one another. The one is just in a fund structure. Although I said we don't really focus on managing funds, where we've got clients that are worried about certain tax implications and they don't like direct stocks, we give them the fund option as well. And that's also available through Octagon to you at the end of the day. This has all been touched on, so I'm not gonna talk about this at all. I think, Mark, maybe just one thing from our side on the asset swap, and I think it's an important point to clear up here. With asset swap, there are different forms of asset swap as well. So with Sanlam Private Wealth, what we do is where our clients, as has been pointed out already, where our clients invest more than their 11 million offshore and they want to use asset swap, we actually have a facility where we can help clients administer their investments offshore. They are not exposed to capital gains tax via our structure. And the simple reason for that is we don't put them in a fund or a feeder fund or an asset swap fund. We actually just administer it through our nominee company. So talking about all the capital gains tax issues that Mark has mentioned, our clients only have capital gains exposure in the hard currency. So if you think about someone that's got a local trust that's not allowed holding a direct offshore asset, we can help them through that asset swap capacity and still not expose them to the capital gains tax that'll be on the rand. But we can probably deal with 1 or 2 questions on that later. So just getting into the investment side of things, I think we've got a very clear process that we follow in terms of how we select stocks for clients. So we are pretty much what's known as a quality investor, and with a bit of a value undertilt. And what I mean by that, what do we mean by quality? Because I think a lot of people talk about quality. What we talk about a quality business is a company that is very good at producing cash flow. So I think a lot of companies show you good results in the media, but a lot of that is through different ways of accounting structuring. I think if you really see a company that is good at taking their operations and whatever capex they've spent and how to generate real cash flow in the business. And those are some of your, I'll touch on some of them just now, but some of your consumable stocks. If you look at the Nestle's of the world, the Unilevers of the world, those are the companies that are really good at producing high cash flow. We've seen lately in some of the IT companies, it's not like the early 2000s where IT companies were built on a hope and a dream. You've seen, a lot of these companies producing healthy cash flows. We look at companies that produce very good gross and operating margins. They've got a sustainable growth profile, and we look at sectors that are in a secular growth phase. We try and avoid companies that are on sectors that we feel are in a secular decline. That could be anything. Some of the energy companies that we know is probably facing some headwinds into the future. So we try and avoid some of those companies. And I think quite important, what we've seen certainly over the last year and through this COVID crisis is the balance sheet. And I think people often underestimate the balance sheet. Through the companies we look at is companies that have low leverage or low debt levels on their balance sheet. That is critically important for us, because we typically invest through investment cycles, and in investment cycles like we see now where there's a downturn in the market, companies with high leverage tend to feel the pain a lot more than other companies. So that is a very important point for us. The other points are quite straightforward. I mean, low capital requirement. We typically don't like capital heavy businesses that have to invest in massive infrastructure the whole time and recapitalize that over time. They've got high returns on that capital, events reading into your cash flow generation. And they can also be quite dynamic with their capital allocation in the business and in the jurisdictions they operate in. But I think quite important through all of this, is looking at businesses that are either market leaders in the industries they're in or the sectors they're in, and they've got a strong moat around them as well. So what does it actually mean? How does this all work? So we start with a universe of about 2,700 global stocks. We go through quite a rigorous quantitative screen. So we look for all those qualities that I've just spoken about. And I think with all the systems nowadays, it's quite easy screening for those characteristics in the companies. And that brings it down to a watch list on our side of about 120 companies. And that's where our analysts hit the ground running, and they do a lot of work on those companies. They meet with management, they go to the presentations, they do a lot of reading on analyst reports and really study the financials of that business to understand where they are on their cycles. And then we basically construct a portfolio at the end of the day, as I said, probably between 25 and 35 stocks. And I think a very important thing, what we are as an active manager and a private client portfolio manager, is we are not benchmark aware. So what that means, you'll find a lot of people always say they're looking at the benchmark and they'll go either underweight or overweight certain sectors. We are completely what we call benchmark agnostic. So we don't look at the benchmark. I know our clients are very benchmark aware always. I think we often overestimate how much clients look at the benchmark, but we basically look at the quality of the companies. We look at the risk those companies bring to the portfolio, and we look at how we construct these companies together to give a good balanced outcome for clients through different market cycles. So the portfolio construction is very important, and we do that from a bottom-up approach. We don't look at the benchmark first and then look at how we move off that benchmark. And I'm going to touch on the benchmark in the next couple of slides just to give you, I think, some input as to why that is important. So within our portfolio, so we typically take positions in a company between 3 and 6%. It might not mean a lot to a lot of people, but I'll show you how a benchmark typically is comprised so you can see what that means and what the difference is. I think a very good culture in terms of the team that does a lot of debating and discussion around these stocks. So it's not one individual that sits there and makes all the decisions. And at the end of the day, as I said, the portfolio construction is important to balance the risk and reward. So you've always got to make sure with any investing, there's risk, but you've got to make sure that on a probability basis, you've got more skewness to the upside than the downside. And that's typically, if you look at the portfolio over a couple of years, over the last sort of 6 years that it's been running, we typically capture only about 70-80% of the upside of the market, but we avoid the downside by a larger proportion. So over time, you get better growth for the clients. And I think that's quite an important point. And then we are quite active in the portfolio, so we're not scared to trim when we think the company's share prices have run beyond their fundamentals. And if you look at the recent volatility, we've actually been very active in the portfolios where we could go in and out of certain stocks because they have literally either run too far or fallen back too hard. And it often gives us an opportunity to get out and get back in at better prices for the clients. So just before I get onto the benchmark stuff, I just want to show the performance because it's all good talking about these things. What has it actually delivered for our clients? So the easier one to show is the high quality fund. So as I said, the diversified equity portfolio follows, they're basically a mirror of one another. So the blue line that you see at the top here, that is the high quality fund since its inception in 28th of Feb 2014. And you can see the next line down, which I'm always bad with colors, and I'm sure some of the ladies listening will tell me that's not caramel, that's brown or something else. But if you take this caramel color here, that's the market as we know it globally, the MSCI World. This next color down here, the black color, is the average of all the people competing with us in the market. So all the other fund managers in the UK that are managing global equities, this is how the average fund is performed in our call it our peer group. And then just for interest's sake, because I think, when Menachem started this presentation was to say diversifying out of South Africa and, the risk of investing offshore. So if you look at the JSE, which is this bottom line here, what does that actually produce over the same period in dollar terms for clients? So you can see the massive difference that is actually this dislocation that's happened. And there's a number of reasons for that, but I think it's quite important to show the difference that's happened there over a period of time. That said, remember the JSE has also done very well for clients over a longer period of time. So it's not something, I'm not saying you must move away from the JSE completely, but it's just something to show how that's performed. I want to touch on this for a second because this is just the annualized performance, so how we've done over 1, 3, 5 years and since inception. So that's basically just showing if you had to annualize that blue graph, we've compounded about 9.3% per annum since inception versus the benchmark of 8.1 and the sector of 6.1. And that is despite over the last year where we've actually underperformed the benchmark by 6%. And that's what I want to spend some time on, because I think it's quite important where we are today with all the movements going on in the market. And I think, Menachem, we can probably chat about that in the question session, what has gone on and why that is, what is going on, and I think what we see going forward as well. I'm not going to touch on this. The team manages roughly 1.8 billion, and they've won a number of awards. So I think it's just always important showing there's at least a stamp of approval that the team has done well, and they've won a number of awards globally for the performances. But I think this is the stuff I was going to spend a bit of time on. I just want to see, we still got a couple of minutes. So if you look at our fund, and I just want to, this is at the end of August. So if you look at the fund versus the index that everyone will measure us against, which is the MSCI, the MSCI World Index, the MSCI sits with 1,601 stocks in the index. So if you typically buy a tracker or a ETF or something like that, you'll get that full basket of 1,600 stocks across the globe. As I said earlier, we typically buy about 25 to 35 stocks in a portfolio. And just interesting to see the weighting differences. So our portfolio, as I said, between 3 and 6% per stock. So the top 10 makes up about 35% of our portfolio. So if the interesting thing what's happened over the last while in the world, if you look at, I mean, Alphabet is, I mean, sorry, that should be the A and the C shares, but there's typically about 2%, it's the owners of Google. And you can see the top couple of stocks are all above 1%, but the top 10 makes up about 17% of the index. So that means the other 1,500, almost 1,600 stocks that's left there makes up the balance of the 52. So you can see, you can imagine from 0.7 down, there's a massively long tail of stocks that sits in this index. So our conviction and where we sit as portfolio managers, we back ourselves to buy good quality companies, as I said, on the back of these cash flow generation, on the back of good moats, good solid business plans, and we will rather buy a smaller portfolio of funds that of assets that we think will deliver better results for our clients over time. Now, why have we underperformed the last 12 months? So I think if you go look what's happened in the world, so these bars just show you the last 12 months performance from the world index. So the world index has done roughly just under 8%. If you just look at the larger companies within that index, it's done about just over 8%. But all the growth has come from the US. You can see the US has done roughly 12%. But US large caps, so all those big mega cap stocks in the US has done about 14%. So without doing too much fancy maths, if the MSCI World, which is made up 60% of the US, did 7-8%, and you're saying that the US did over 12%, that means just very simplistically, the rest of the world actually lost value for clients. So I think that's quite an important point to make. And this shows and I've just taken it since inception till roughly end of August, since the time our fund started 28th of Feb. You can see again, the US delivered about a cumulative return of 100%. Japan's, interesting enough, was the second best performing market at just over 40, with emerging markets behind that. And you can see down here is the UK that actually underperformed and did a negative return over this entire period, with the MSCI sitting at about 60. Now, if I look at our performance and our positioning over this period, we were about 15% underweight the US and about 4 times the benchmark weight of the UK. So just looking at that, we should have over this entire period underperformed the index, if you just think about it in cold facts. But due to the stock picking, we actually had about an 18% return over this period in the UK, because remember, the UK has got some very good global companies that have done extremely well. They've got a lot of other companies that have done very bad during that period. But again, stock picking for us is very important. That's how we drive the performance for our clients. And just 1 or 2 of these anomalies that's kicked into the markets. And I think with all the stimulus that central banks, so all the free money that they're actually throwing into the market at the moment, it is something that I think is keeping all of us up at night. We don't know. I don't think anyone's got foresight how this is going to end. But what the result has been is you've got some companies that have actually just gone parabolic in their returns over the last couple of years, well, maybe the last year or 2. So what has happened in the S&P, and what this graph shows since 1980, is the concentration of the top 5 stocks. So what percentage does the top 5 stocks make up of the entire S&P 500? And we can see over the last while, since about 2015, this is almost doubled. So you've got big concentration actually happening with a couple of stocks driving the entire market, and the rest of them are actually not doing that well. And here's one or two examples of that. We all know Apple. I think a lot of people love Apple or hate it, depending where you look at it. But Apple has done extremely well. It's an extremely well-run company, and we know a very successful company. And it feels literally like a couple of months ago where we were talking about whether we can see a $1 trillion market cap company. Apple breached that a little while ago, and we can see what has happened since then. It has more than doubled that in a very short space of time. Now, that is on the back of what these other lines show is the sales and income figures over a 5-year period. So how have Apple managed to grow their sales and their income over that period? And you can see that has actually come down significantly. And if you look at the free cash flow of Apple, it's actually stayed stagnant during this period. So we are concerned. We like Apple as a company, but we are certainly not paying this price for Apple at this point. So those are just some of the important things to note. And we all know Tesla. I mean, words fail sometimes when you look at these stocks. I mean, Tesla has gone in a short space of time with a market cap now of over 400 billion. And I mean, they are now more than the combined, these orange bars are all the car companies in the US and their market cap. So you can see where Toyota sits, less than half of that. And the next one down, I mean, if you look at Volkswagen, Audi, I mean, all of those combined don't even make up the total value of where Tesla sits today. And again, what's happened with the share price on the right here over a short space of time. So those are the things that we will rather avoid as a business. It has led to us underperforming, but we are comfortable with that underperformance because we just see too much risk in these stocks for investors. And we don't think that these things can continue. Menachem, I think we're running a bit out of time, so I'm not going to spend too much time on the positioning of the portfolio. But I think just in conclusion, I think our view is there's a complete disconnect in the market from the fundamentals of the businesses and what we see as good prices for businesses that one should pay and be comfortable to pay through an investment cycle. We trust our process. So, we keep checking ourselves when there's underperformance like we've had over the last year. We have to go back and make sure that we are comfortable with the process. We trust the process. We believe in buying high quality businesses at the right price. And we think that this market sentiment is something that cannot continue where we are now. This US, the way things are going there, how long it can continue, that we're not taking bets on that one. But we're certainly uncomfortable with where the markets are. And I still think we're not going to chase those winners. We're going to stick with our process and stick with the stocks we buy in order to deliver the outcome for clients over time. I think I'll stop there, Menachem, and we'll probably
thank you, Reg. That was terrific. Thank you. If we could just please close down your share screen over there. We do have a number of questions. So I think what I'm going to do is there are an awful amount of questions over here, and I want to just take a few moments just to position things because we've heard from everybody. It can get a bit confusing as to what we mean by all this. Reg, I just want to take you off spotlight.
On the big screen.
Yeah, you're still there. Right. There I am. I'm back. Cool. So, not at all. So I think what's important to understand is that the most important thing is, first point of call, talk to your advisor. You've heard today a little bit about Octagon. You've heard a bit about a platform, and there are many platforms. We obviously are very favorable towards GLACIER. And you've heard from Reg about stock portfolios. And putting these all together and knowing what's appropriate for you as an investor, because investing is personal. It needs to be personal. I spoke before about risk profiles. It's very easy to get taken in with what other people are doing. But whether that's relevant and applicable to you is a subjective statement. And I think it's very important to speak to your advisor, to an advisor, about how to do that. And for those people who are not Octagon clients, you're welcome. We will send out information, and you're welcome to the same portal that you came in on. You can speak to us, but we will be communicating with everybody about coming to speak to us and talking about your offshore investing, which will be specific. I want to just ask some questions. I've got some questions over here for Mark, some questions over here for Reg, but let me try to answer some of the questions ourselves over here. So what is the primary difference between what Octagon does and what Sanlam Private Wealth through Reggie does? Well, we're both investments. So we might both use, as Reg mentioned, we might both use Mark Crom's platform, and there were 3 platforms over there, to ultimately do your investment from a tax wrapper, from a probate wrapper, as Mark explained to us. But Octagon runs unit trusts, specific unit trust that we invest for clients overseas and for fund of funds, and Sanlam Private Wealth run share portfolios. So the primary difference between the two of them is that we are running a fund of unit trust, and Reg is running a specified a share portfolio. Okay, so it's quite a big difference. And in my opinion, both are valid. Both are necessary in a portfolio. In my portfolio, I have both. I don't think that one should have singularly one or singularly the other. I think a blend is a really, really good idea. Very happy to tell you that our portfolio performance has been stellar. Actually run out of the Sanlam office in London. What's really, really exciting from an Octagon standpoint is that, as Reg mentioned, this has been an incredibly tough year from an investment standpoint. The FTSE, that's a British index, down some 22% for the year. So if you had money in at the beginning of the year in the overall FTSE index, you haven't made money. But again, as Reg mentioned, some shares have done incredibly well. Some of the tech shares, we mentioned Tesla, Apple, a lot of shares have done incredibly. Gold, done amazingly. And so we've been very happy to been ready. We've actually had a very, very good year from a return standpoint. So we're very comfortable with that. But some questions, Mark, if I could ask you a question over here is...
Can I just stop you there for 1 sec? I think it's just important for everyone to know that within the wrapper, you can have a combination of both. So obviously you chat to your financial advisor, but you could have a combination of Reggie's SPW offshore portfolio and Octagon model. So it's not one or the other. I think that's quite key. So they are very different and they manage very differently, but you can have a combination of both, all sitting within one.
I agree 100%.
I think that's,
and as I said, in my portfolio, I have both, and I think it's very, very important as well. Yeah. So, Mark, one of the questions, while I've got you over here, Diana wants to know, can we draw money from our investments overseas? In other words, if a person has an offshore wrapper with you, they have their South African bank over here, First National, but they've also got a bank at HSBC. Can they have their funds paid into the HSBC account? And at the same time, it's the same question she's asked. Yeah. What would your answer to that be?
So the answer is yes. Within the Global Life Plan, you've got multiple access to the money. So essentially what we do behind the scenes is we don't want to get too complicated, but we create 100 contracts. So essentially what that does is it allows you for 100 partial or full withdrawals during the term. So we will pay that money into any account provided that that account is in the client's name. So whether that account is a local account or an offshore account, liquidity is not an issue. Turnaround time on liquidity, depending on the underlying funds that they invest into, but most funds are traded on a daily basis. So getting the money out of the fund into the trust bank account and paid to the individual probably takes about 10 to 12 working days. But essentially, liquidity should be no concern.
Fantastic. Thank you very much. A question was asked whether whether the presentation will be emailed. All presentations are available on our website, www.octagonfinancial.co.za, within about 4 working days of presentations, and it will be under the news section, but we will be emailing our presentations as well. One of the, just for clarification purposes, Mark mentioned that on the new platform, the minimum requirement would be some 100,000, that's 100,000 Rand. So the old platform is $25,000 US, and the new platform is some 100,000 Rand. We're also very excited to tell you that I was just talking to Mark offline now, that we'll be able to handle monthly investments as well within about 6 months of now, hopefully even shorter, but we're hoping to have that within about 6 months now. A quick question for you, Reg, if you don't mind. A question was asked over here. What is the difference between your option and going through easy equities investing? I'm not sure if you know the answer to that, but at the same time, second question, if you could address briefly, please, is why the Johannesburg Stock Exchange returns have been so low of late, and I suppose that's over the last 5 years.
Yeah, so thanks for that, Manahal.
Sure.
So easy equities, look, it's an online trading platform, and you can access stocks and buy stocks globally through that. I think our difference is we manage, so you give us a mandate to manage the money on your behalf, and you buy into our process philosophy. You know, what we do for clients is basically make sure that we manage the money in a very responsible manner going forward. So again, it depends whether you want to manage your money yourself or trust someone like ourselves to manage it. So I think that there's one of the probably big differences. I think they might have some other solutions where they have portfolios, and I haven't looked at those, or I don't know if they've got other offerings on there. But then I think in terms of the second question, why the JSE has done so poorly, I think it's actually done a lot worse than we think, because if you strip out one or two of the big stocks like a Naspers, and you look at how the rest of the stocks have done, and I know Menachem said earlier that the JSE is one of the most diversified stock exchanges in the world, but some of those big names have done reasonably well. So if you look at something like a Naspers, has kept up with, because of their holding in Tencent, have kept up with some of the big tech stocks globally, so that's done phenomenally well for clients. But some of the other stocks have been absolutely battered, and that is a lot to do with the lack of confidence in investing in South Africa. People don't want to put money into the country. It's got a lot to do with the structural challenges we have from an economic growth point of view. So the market is reflecting the sentiment of the global capital allocators that aren't investing here as much as they used to, and also the structural challenges in South Africa itself. So I think that's in short. You could probably get into a lot of detail there, but that's in short, I think, the reason. So
absolutely, thank you very much. And then I think the last question, going back to Mark over here, is we just wanted to confirm which would be the right platform for if a client's considering investing and they want to know the platform. Obviously they're going to come by an advisor and we'll advise them, but just on a brief quick headline, which would be the better platform, and when does that person consider one platform versus the other?
Are you referring to platform being different institutions, or are you referring to?
No, I'm talking about your two platforms. So the Global Life Plan versus the new platform.
Look, I think if you can get into the Global Life Plan in terms of a minimum requirement point of view being $25,000, I definitely think that would probably be the preferential platform. And the reason why I say that is because it comes with many advantages. So obviously you get the ability to have multiple owners, you get the ability to have beneficiaries, all tax planning is taken care of. It's taken care of at a preferential rates. So you get all those benefits. Whereas the offshore investment plan, the new plan, I would say, is someone starting out building up that minimum to get to the Global Life Plan. So it doesn't have the bells and whistles of the ability to nominate beneficiaries. So you'd still need an executor to deal with, winding up that, even though it's quite a simple process because it's administered locally, an executor would still have to get involved in that process. Tax would be in your own personal capacity, which means it would probably be at a higher rate. We just getting rid of some of the cons, for example, the taxation in rands versus hard currency. But I'd say if you've got the minimum to get into the Global Life Plan, that product is far superior than the offshore investment plan. But what I will say is the offshore investment plan is your starting point to build up enough capital to actually transfer it into the Global Life Plan, especially if you're looking at a recurring point of view.
Absolutely. And I think what's important over here is to go through your advisor, and your advisor will take you through this. And just to
I think so too.
There's one more question over here. If you can add funds after your initial lump sum, and the answer is yes. There are minimums, but we can discuss that around. I'll have a chat with you about that offline. But I just wanted to start and say thank you to Mark, and thank you to Reggie, and thank you to you, ladies and gentlemen, for joining us today. This has been a really, really wonderful webinar, I think. And please watch your mail. There's a new webinar coming up. There's one, I think it's the 3rd of October, if I'm not mistaken. And it's going to be also a very, very exciting one. And there will probably be one in between as well. So ladies and gentlemen, thank you very, very much for joining us today. Thank you to Susan and to Stephen for your input as well. And wish you guys all well. Stay safe, stay healthy, and stay warm. Thank you very much, ladies and gentlemen.